Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into the recent surge in Toronto area home sales, sparked by price cuts. It appears that a delayed spring market led to a very active July as buyers responded to substantial price reductions.
That's right, Steve. It seems like buyers were quick to take advantage of these price cuts. According to Andre Coutyan, a broker with Harvey Callis Real Estate, he saw a sudden increase in activity and managed to sell about 10 of his own listings in July after adjusting their prices.
Absolutely, Janine. The average price in the Greater Toronto Area fell 5.5% in July compared to the same month last year, according to the Toronto Regional Real Estate Board. At the same time, we saw new listings increase by 5.7% and active listings swelled by 26.2%. It's clear that the market is still adjusting.
And despite this improvement in sales, Darren King, an economist with National Bank of Canada, points out that transactions were notably lower on a historical basis. July's sales were 12.8% below November's sales, which was the peak before some of the trade uncertainties began affecting the market.
Indeed, Janine. Mr. King estimates that prices in the GTA have cumulatively dropped 5.1% since November. He suggests that consumers are getting used to the uncertainty, particularly around trade conflicts, but the market balance is still leaning towards buyers. The active listings to sales ratio is around the softest level since the 2008 to 2009 financial crisis.
And while some buyers are feeling confident, the job market remains a concern. National Bank economist Jocelyn Paquet mentions that the latest jobs report from Statistics Canada showed a loss of 41,000 jobs in July. This was unexpected, as economists had anticipated a slight gain. It's understandable that employment uncertainty could affect buyer confidence.
Yes, and according to Mr. Coutyan, many transactions are happening because sellers recognize the opportunity cost of holding out for a higher sale price. For instance, he mentioned a 3-bedroom house near Yonge Street that sold for $1.925 million after initially listing for $2.199 million. The homeowners had originally purchased it for $2.52 million during a bidding war at the market's peak.
That's a significant price drop, Steve. And it seems that many sellers are now willing to make these adjustments to ensure a sale. Buyers, on their part, are weighing the benefits of buying now against the possibility of further price drops.
Exactly, Janine. It's a strategic game of timing and patience for both buyers and sellers. For example, a 4-bedroom home at 12 Tetbury Crescent eventually sold for $4.55 million after several adjustments and years of on and off attempts at selling.
And in some cases, sellers are opting to lease their properties if they can't sell at their desired price. This was evident with a ranch-style bungalow in the Wanless Park neighborhood that eventually sold for $2.72 million after several price cuts and even listing it for lease.
That's a smart move, Janine. It adds another layer of urgency for potential buyers. As we look ahead, Mr. Coutyan is preparing for the market after Labor Day, but he remains cautious. While some sellers are hopeful for a trade deal or lower interest rates, he believes inventory levels will be the key factor moving forward. Now let's shift our focus to mortgage choices. We've been seeing some interesting insights from Leah Zlatkin, a licensed mortgage broker and expert with lowestrates.ca. She emphasizes that Canadians should look beyond just the interest rates when choosing a mortgage.
Absolutely, Steve. Leah Zlatkin points out that while interest rates are a significant factor, they are not the only consideration. Mortgages are complex financial agreements, and there are several elements that borrowers often miss, which can lead to costly surprises once the mortgage gets underway.
That's right, Janine. According to Zlatkin, it's crucial to look at the entire structure of a mortgage, including any potential fees and penalties. These can become quite expensive if your plans change, and with many renewals happening right now, it's important to be aware of what you're signing up for.
And Leah Zlatkin suggests 4 key areas that homebuyers should focus on. First, looking beyond the rate itself. Sometimes those low rates come with restrictions like limited prepayments or high early repayment penalties.
Exactly, Janine. It's essential to understand all additional charges. Buyers should request a full breakdown of fees, including administrative, appraisal, and legal costs, to prevent unexpected expenses.
And it's also important to know how penalties are calculated. For instance, early repayment, refinancing, or moving can result in penalties that might be worth tens of thousands of dollars.
Leah Zlatkin also highlights the importance of considering long-term flexibility. Features like portability, ease of refinancing, and prepayment privileges can save money over time, even if it means opting for a slightly higher rate.
That's a great point, Steve. With multiple lenders offering similar rates but different conditions, the most cost-effective mortgage is often the one that balances rate, flexibility, and long-term security.
And given the current market conditions, with the Bank of Canada leaving its benchmark rate unchanged and fixed rates remaining high due to 5-year Government of Canada bond yields, it's more important than ever to evaluate these factors carefully.
Indeed, the decision around choosing a mortgage is more complex than just finding the lowest interest rate. It's about finding a mortgage that truly fits your needs and financial situation.
Today, we're turning our attention to a recent piece of research published by the Canada Mortgage and Housing Corporation, or CMHC. This analysis focuses on 3 crucial factors affecting Canada's rental housing market: rent control, real estate investment trusts, or REITs, and evictions.
It's an important topic, Steve, especially in light of the high costs of home ownership in many Canadian cities. With such costs, renting has become the only viable option for a lot of people. But with low vacancy rates, many tenants are facing steep rent increases when they move to different rental units.
Exactly, Janine. The report highlights that for the rental market to stabilize and improve affordability, we need a significant and sustained increase in supply. CMHC underscores the importance of private sector investment in rental construction, as governments alone cannot bridge this supply gap.
While private investment is crucial, the report also acknowledges concerns about private landlords potentially charging higher rents or exploiting tenants. It's a delicate balance between ensuring effective tenant protections and encouraging private sector investment.
CMHC's Deputy Chief Economist, Aled Abyorworth, emphasizes that increasing supply is key to restoring affordability. He argues that issues with landlords should be addressed by strengthening tenant protections, rather than discouraging private investment.
That makes sense, Steve. The report also delves into the impacts of rent control. It finds that while rent control can stabilize rents for existing tenants, it can also lead to lower rental supply and reduce tenant mobility in the long term. Plus, it can accelerate rent growth for new and vacant units.
Right, Janine. The research looked at the role of real estate investment trusts, or REITs, in cities like Montreal, Toronto, and Vancouver. It found that REIT properties are often located in pricier areas, but interestingly, the ownership type doesn't significantly impact rent prices compared to similar non-REIT properties.
And when it comes to evictions, the research used data from the Canadian Housing Survey, estimating that about 1% of renters were evicted each year from 2021 to 2023. That's roughly 49,000 households annually. This data is vital for understanding and addressing eviction trends.
Indeed, Janine. The CHS data provides a valuable starting point for further dialogue and research on evictions. It's clear from CMHC's analysis that a nuanced approach is necessary to balance the needs of tenants and landlords and to foster a healthy rental market in Canada. Windsor is getting a significant boost from the Ontario government. The city received a $5.2 million grant for surpassing its 2024 housing targets under the province's Building Faster Fund. This is a notable achievement, as Windsor exceeded its housing target by over 200%.
That's impressive, Steve. It shows a strong commitment to addressing housing needs in the community. Premier Doug Ford praised Windsor, calling them the Ontario champs for their efforts. It's heartening to see a city recognized for making significant strides in housing development.
Absolutely, Janine. Windsor broke ground on 2,306 new homes in 2024, which is well beyond their initial target. It's worth noting that the province's numbers include additional builds, such as long-term care beds and student housing, which some have questioned. However, Ford defended this inclusion, highlighting the broader impact these units have on freeing up other housing.
Certainly, Steve. Including such accommodations can help alleviate pressure on the overall housing market. As people move into these units, they vacate other homes, creating more opportunities for families. It's a holistic approach to tackling housing shortages.
The Building Faster Fund is a 3-year, $1.2 billion initiative encouraging municipalities to expedite housing approvals. Municipalities meeting 80% or more of their targets receive funding for infrastructure, which supports new home construction. Windsor's success here underscores the effectiveness of such incentives.
Mayor Drew Dilkins pointed out that Windsor's growth is closely tied to the support from the provincial government. It's clear that collaboration between local and provincial entities can drive meaningful progress in housing development.
Premier Ford also discussed broader economic issues affecting Windsor, including U.S. tariffs and their impact on the local economy. He's planning to meet with Prime Minister Mark Carney to discuss potential measures like lowering corporate tax rates and pausing the HST on new home sales. These steps could further stimulate economic and housing growth in the region.
It's crucial to address these economic challenges, Steve. The Premier's commitment to rolling out more funding and pushing for onshoring manufacturing of steel and aluminum products shows a proactive approach. Such measures could bolster Windsor's economy and support its housing market.
In our last segment today, we're looking at some intriguing financial news regarding the Ontario Teachers' Pension Plan Board. The board has reported a loss on its real estate investments, yet it still managed to achieve an overall profit within its portfolio. This is a fascinating development, especially as it echoes similar trends among other Canadian pension funds.
That's right, Steve. While it's concerning to see a loss in their real estate investments, it's heartening that the overall portfolio is still performing well. It highlights the importance of a diversified investment strategy, which can help cushion the impact of underperforming sectors.
Absolutely, Janine. The Ontario Teachers' Pension Plan Board isn't alone in this. Many Canadian pension funds have been experiencing similar challenges with their property investments. It's a reminder of the unpredictable nature of real estate markets, which can be influenced by a variety of factors including economic shifts, regulatory changes, and market demand.
And it seems like the board's broader investment strategy has paid off. By maintaining a diversified portfolio, they've managed to offset the losses in real estate with gains in other areas. It's a testament to their financial acumen and strategic foresight.
Indeed, Janine. The Ontario Teachers' Pension Plan Board is known for its strategic approach to investments, and this situation underscores the importance of not relying too heavily on any single asset class. Diversification is key to mitigating risks and achieving long-term financial stability.
It's also worth noting that the real estate sector has faced numerous challenges over the past few years, from fluctuating property values to changes in demand due to the pandemic and economic uncertainty. These factors can significantly impact investment returns.
Exactly, Janine. And as we look to the future, it's essential for pension funds to continue adapting their strategies to navigate these complexities. The Ontario Teachers' Pension Plan Board's experience serves as a learning opportunity for other investors.
Absolutely, Steve. It's a reminder of the resilience and adaptability required in today's financial landscape. As always, staying informed and flexible can make all the difference in managing investments effectively.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, Their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.